Alan, appreciate you joining us today.
So my name is Alan Strauss. I'm a senior partner and director of investor relations here at Crystal Capital Partners. I'm a father of three. I think that's important to mention, twins and a slightly older young boy. I've been here at Crystal for over 15 years. We as a firm have been investing in alternatives, specifically hedge funds and private markets since 1994. Today, as opposed to being a product provider, which is what we were at our founding, we provide a very turnkey solution, an investment platform with a full user interface, tools, technology, the ability to gain operational efficiency and scalability, and an approach that helps advisors who are independent, so RIAs, bring institutional investments specific to hedge funds and private equity to their qualified clients' portfolios and be able to essentially do what the largest and most sophisticated investors have been doing for the last 30 to 35 years with respect to alternative investment. We are an RIA as well, and 9% of the assets here at Crystal Capital, like many of the funds we work with, where GPs are sizable investors and ultimately create a direct alignment of interest with their clientele, and really sit on the same side of the table as their investors. And that has been our MO going back to the early 90s when our firm started, and inclusive of going through 2008, when as a fund of hedge fund structure, we recognized just really the structural inefficiencies. And so while the world figured it was going potentially to a barter system, we felt that hedge fund managers would continue to deliver on their mandates. Certainly not all funds are created equal. And there is a very large disparity between what continue to be top decile performers, which were many of those funds that were around back then. And so what we recognized is that there has to be a better, more efficient way to invest in managers that deliver value, net of all expenses, but that also could allow for a little more scalability in our business. While in the 90s and through 2008, we were really providing a product to small institutional allocators as well as high net worth investors. And the ability to pivot the business and really evolve it is a better word, to continue to give exposure to institutional elements of the asset class, but to be able to provide a truly scalable solution and work with investment advisors who at that time, just as it is today, is one of the fastest growing channels within financial services. And as more and more investment advisor representatives, the individuals, look to create businesses that are scalable, support their customers, support their clients, their investors, that's really where Crystal was trying to carve a niche. And certainly in the 20 years since our inception, or over 30 years now since our inception, but certainly since 2008, that's really been what we've been able to do in terms of the platform that we have, and that I'm sure we're going to discuss today. The founding partners of our firm, which really were two families that initially came together to manage assets in a more intelligent way, were able to quickly discover the value that hedge fund managers, which at that time was earlier on, the institutional established managers we see today, many have alluded to it as more of a cottage club industry, smaller funds. It took a lot of networking to get exposure there. And you started to see many of those funds have some relationship with large bank platforms. And that was kind of what allowed us through different relationships and introductions to create a multi-strategy pooled vehicle of underlying hedge funds. And in a pooled vehicle, the issue is that when there is uncertainty and volatility in markets and liquidity feels as though it's drying up, it is not a very advantageous structure. So that was a great business. It allowed for investors to have access to institutional fund managers, to do it at lower dollar minimums, to have a professional team managing a portfolio. But clearly post 2008, when we go through a liquidity crisis, and again, us being large investors in our own structures, then as we continue to be today, 9% of the assets here at Crystal is our money, partners within the firm, myself included. This really allows the evolution today allows investors and their advisor to really take control and ultimately meet their individual objectives, as opposed to going into a canned product that may or may not achieve objectives of groups or individual investors through time.
Yeah, that's really interesting, Alan. And I guess from that lens, as you're talking to investment advisors, what was the role of alternatives? What does it play in an asset allocation perspective? What does that look like from your lens?
It's a great question, Skylar. I think the adoption rates of advisors coming to alternatives are continuing to increase. And I think if we just look at things from a 30,000-foot view, we really feel that alternatives can satisfy three main objectives. So, and by understanding what those three main objectives are, we then can understand which is the maybe more appropriate asset, although all three categories, meaning hedge funds, private equity, and private credit, could be applicable. So those really three parameters are identified by having an investor or investors that have as objectives to say, I want to mitigate risk. I want low vol. I want those shock absorbers in the portfolio. It's fun to get on a roller coaster like equity markets provide from a volatility standpoint. But, after a 2-minute ride, I want to get off. Right. So for an investor that's talking about those personal feelings, that's really where hedge funds and a handful of low vol strategies, whether it's multi-strat, equity market neutral, relative value, that is where those strategies really fit the bill. Then if you're looking at an investor who says, well, I really want to take advantage of growth. And investors can certainly look at public markets for growth. But over the last few years, we've really seen 7 companies, technology focused for the most part, carrying the S&P. And in addition, since just 1996, we've seen close to 50% less available entrance into public markets or available investment opportunities for investors within public markets. So you have a shrinking public market, you have an ever-growing private market, and it would seem that the potential for growth opportunities should take advantage, or the investor's desire to take advantage of growth opportunities should have exposure to private markets and from a private equity or leverage buyout or venture capital or growth equity. So equity being the operative word, and in the private markets. And then the third element to consider is an investor's need for income. And really that depends on their life stage. Many investors look to public fixed income, but there's also the ability to gain that yield, that income component at a premium to traditional fixed by using private credit managers. So by having all three of those elements, that's really what those are the kinds of conversations we're having with advisors on a day-to-day basis. And ultimately hoping that they understand that our platform can help deliver that mandate, and in a very customizable fashion, in a very scalable fashion, and in a very technology-friendly fashion, so that advisors can bring this asset class with no barriers to entry or very limited barriers to entry to their clients. So it goes back first to the fact that we are 9% of the assets. I don't mean to, I'm saying that in a very humble way. I'm not saying that to celebrate anything, but it's to drive home the point that there is a direct alignment of interest. In other words, nothing would come on the platform that we wouldn't invest in ourselves. So that's one of the important parameters. Next, you're looking at funds that have developed a track record through multiple market cycles. While there is certainly merit to be had for emerging managers and startup funds and things of that nature, we are inclined to mitigate that level of business risk. And so we're looking at firms that have, again, been through multiple market cycles and are somewhat time tested to continue to deliver on their mandate and net of all fees and expenses. We look across the board at the entire universe. As I mentioned at the outset, there is a very large disparity between the top decile funds in the alternative category versus in the traditional investment category. In other words, most mutual funds that are tracking the benchmark, you get a large swath of funds that the variance between the benchmark and them is not so significant. So making a, within quotes, mistake in manager selection is somewhat palatable. But in the alternative investment space, when you're looking at private equity or looking at private credit or private real estate, that disparity between top quartile and bottom or top decile and bottom can sometimes be over 20%. And so that mistake is very detrimental to the long-term objectives of an investor. So we want to make sure that we are bringing onto the platform, funds that, by the way, don't pay us absolutely anything, right? So we're not getting compensated by funds on the platform. We get paid by assets that flow through our structures. And naturally, the funds that we're looking at, again, they have stood out. It's the skill of the manager that determines the real value of an alternative investment fund or a hedge fund or a private equity fund specifically, as opposed to a traditional investment manager who's driven by the market's direction. So we also have a third-party due diligence firm that we contract out to support our efforts in operational due diligence. And we are meeting consistently with managers in addition to, benchmarking across the universe so that there are funds on our platform. There's roughly 60 funds across hedge and private markets at any given time. And we are always, curating the menu, reviewing the menu, ongoing due diligence on the funds that are on the platform through calls, through visits, through conferences, through commentary, and then providing all that information to our community of advisors who number over 250. So we work with over 250 firms nationwide so that they have access behind a firewall to this level of information and have access to our team. So I'm going to come full circle 1 second. The value of the fund of hedge fund product at a given point in time was professional management, access to institutional or top, institutional funds, funds that were highly recognized through time. And we have continued to bring that as a service component. So advisors no longer buy a pooled vehicle. They are not buying a fund of funds. They're building portfolios unique to their clients' objectives and still have Crystal's team to support them in the process and Crystal's information, which is available on our website, to continue to support themselves, their decision-making, as well as that of their clients.
That's definitely very interesting, Alan. I guess you brought up a lot of different things, which is talking about private markets, obviously, and the opportunity or demand in the marketplace for focusing on the private aspects of those markets, which can maybe be considered as an all-weather strategy, right? What's the impact of timing of investments in the private space relative to the current market cycle? What are your thoughts there?
We really believe that there's no such thing as timing. I think that's a great question, though, Tyler, because it comes up a lot. The reality is that everyone talks about the endowment model, which is to take advantage of private markets and to have continuity in investments and have a process. But the operative word in endowment model is endowment. So if you're not an endowment, you can't participate. And that really is something that we're not keen on. So we do think that with Crystal's help, an advisor can help their qualified client who's not a $500 million investor, but is a qualified individual by the SEC standard, and give them the same opportunities that the endowment model provides. Because the data is there, right? These institutional allocators who for 30 years have made appropriate decisions about their investment behavior and have had exposure to alternatives have far outperformed their peer groups. And we're talking about, who are often referred to as the largest and most sophisticated institutional allocators, university endowments, U.S. pensions, sovereign wealth funds, et cetera. And then high net worth investors are continuing to increase their exposure to alternatives, but now they can actually leverage a platform with their advisor that also provides them a very rigorous process to do it.
Yeah, you mentioned platform as a word. I imagine that by having a platform, you can allow the advisors or give them a way to educate their clients as well, I would assume. I'm curious kind of what you guys thought about with that.
Without question. I mean, I often refer to it as end-to-end, and that is maybe an overused concept in our techie society today. But end-to-end would imply that from beginning to the very end, you have support and can execute on these elements. So if you're looking to invest in alternatives, you need sourcing. If you're doing the sourcing, you need access to information. Once you've put together that information, then it's about creating models that give you the data on it. So it's not just a qualitative review, but a quantitative review. And then it's about, delivering some kind of a proposal to a client that has qualitative, quantitative, and educational components. We feel there should be some business development around it. In other words, the advisor can't always send a proposal, but sometimes they want to send educational information about a theme, about a specific strategy. And then is the management of these investments. Skylar, you're very familiar with the administrative burden and the operational complexities that come with alternatives, and we've simplified that. And then is the ability for that advisor to potentially continue to nurture that investor and their investment process along the way. That has been the key to success for institutional allocators. They have to be serial allocators. In other words, have continuity in the process. And that's really what Crystal aims to provide to advisors from beginning to end, a support service, not just a product and not a consultative approach that says, hey, here's 360 pages about the asset class. Everything in here is valuable, but you figure out how to execute it. There could be nothing more frustrating.
Yeah, there's no choose your own adventure. You get help with that process, right? It's not just you don't have to advise.
Sure, but it's designed so that for an advisor who feels they are very sophisticated at it, for them to ultimately have the keys to the kingdom and be able to do it. And it's at no expense to the advisor to work with a firm like Crystal. And then for it to have genuinely scalable elements for the business of the advisor, because the advisor is ultimately doing this to create a business for themselves, and bring, a caliber of service to their clientele.
Yeah, that's great. You're giving them resources, tools that they can kind of help build their own business for their end client, their end user, which is pretty amazing.
Alan, so obviously you have a lot of exposure to different companies, different investment managers, and different investments that these investment managers are making, whether it's hedge funds, private equity, private credit, you name it. Talk to us about some of the trends that you're seeing within the market, and what are investors focused on? What are investors excited about these days?
That's a great question, Mike. Been having those conversations significantly, especially as we head to year end and folks look at year end planning, and obviously where they're looking to deploy assets in 2025. I guess maybe I can talk about 4 specific things that are most topical, or let's talk about 3 asset classes, I guess. And then the 4th one I could give you is a couple of the trends that investors and their advisors are looking to take advantage of. So first and foremost would be, we're seeing volatility in markets. We're seeing a presidential change, right? There is a new regime, for lack of a better word, that is coming into office. And with that, there's the anticipation that there's going to be continued volatility, right? Whether it's deregulation that starts to take place, whether interest rates start to come down, depending on what the Fed does. But that's from us having conversations with managers. Those are some of their expectations, and as a result, we're seeing geopolitical market rattling, and we are seeing volatility. And so hedge funds, as a generalization, are a highly sought after asset class, because more and more, if you look at what advisors are trying to create for clients, is an evolution of this traditional 60-40, right? No one is trying to throw the baby out with the bathwater, but it's quite possible that nowadays it's somewhere like 40% to your public equity, 30% to your traditional fixed, and then 30% are in alternatives. And that's a topic that we tend to discuss a lot with advisors. The problem is, how do you carve out that 30% to alts and some of the other barriers to entry that we talked about? Because the reality is that 30% for a client who's working with an advisor is really a few $1 million. And it's not tens of million or hundreds of million, which is what the typical institutional allocator can work with. So now this is one way Bristol can help to bring hedge funds into a client's portfolio. And that really happens to be one of the parts that will bring risk mitigation to a client portfolio. And that's how advisors are looking at it. I think the second asset class, if we want to call it that, would really be around private credit. And again, as we touched on the outset of the podcast, looking at things from a 30,000 foot view, that second element, if an investor is looking for income and they want to do it at a premium to traditional, and the data is there. We work with handfuls of managers that have at any point in time, whether it's zero interest rate environments, rising rate environments, but over the last 2 decades, have continued to deliver 500-600 basis points premium to risk-free, if not more, and to do it with very low, if not no default rates, which ultimately becomes the enemy to yield. The third element is growth equity, right? We talked about also at the outset, a shrinking public equity universe. So when investors are genuinely looking at growth, we start to see growth equity as a real option. These are companies that already have product lines, already have teams in place, but are looking to scale businesses. And as a result, they need flex capital to continue to grow, and ultimately navigate from an investor standpoint for their needs for liquidity, either toward a public exit or to a corporate acquisition, which both right now obviously have not been happening in droves, but is one of the anticipations that, again, with a change in regulations, a change in market policy, a change in rates, potentially coming down, then those activities will obviously tick back up. So I think those three are important elements from an asset class standpoint. And then if you want to touch on a couple of the themes that advisors are really talking about, those things start to navigate into sports equity, and either taking ownership of sports properties. And as we all know, we're all around the same age. If you said to someone, own sports equity or get involved in sports equity, that's not just owning a team or having exposure to a team. There are so many more revenue streams that sports in general, from professional to amateur, provide, from the marketing of their content to ticket sales to youth sports, as examples of things that have investors thinking, asking the question, wondering, how do I get exposure to this? So it's our job to find managers that are not the trend followers of getting involved in the sport industry, but those that have been doing it through time. And that really would fall in line with the MO, the types of funds that we want to continue to work with. I think maybe the biggest buzzword is artificial intelligence. And artificial intelligence, in our view, has really bled into new age infrastructure. So as opposed to bridges, tunnels, and roads, let's think about AI and software. So SaaS being that third piece, and that new age infrastructure component being, space and telecommunication, right? More satellites in outer space, the delivery mechanisms to get them there, the better communication we have on planet Earth, or even stand on a mountain and there's a provider out there that you just hook up and click into, and you've got internet anywhere in the world. So those types of opportunities, which are part of a digital and technological world, which we've clearly seen in our lives for the last decade, but perhaps we're even more advanced in just the last 4 years in the global pandemic, which started in 2020.
Yeah, definitely. And obviously AI is definitely a big buzzword for many. It's been around forever, but the new infrastructure changes in technology and innovation relative to digital, to your point, is definitely paving the way. I'm curious from Crystal's point of view, from your guys' point of view, what are you seeing internally, or what are you doing from that? Obviously, you built your own platform, which is great. Anything you're doing internally with AI? Just a high level question.
The artificial intelligence use cases that we have been more around leveraging service providers, and so that there are automations, so that there is a speed of delivery of information, whether it's pricing to custodial platforms, reporting of data, reconciliation practices that our operations team uses. But clearly there are many more test cases coming, especially on the user interface and how an advisor would interact with our website and the queries that they could give to the website. There's all of it's happening in development. But from an investment standpoint, right, I continue to say it, and people are probably going to get tired of hearing me say it, but it's, as opposed to finding the trend follower manager, we're looking at the trendsetter manager. So these are funds that have been deploying capital into these spaces. I mean, we work with some software-focused managers who've been investing in software since the 80s, when it wasn't as established and recognized an industry as what it is today, nor were we as reliant on it. So they understand, and they've seen these businesses evolve. And it's not our mandate to bring specific sector exposure to one thing. We're not saying, let's build portfolios of sports equity. We're saying these are important topics and investment opportunities that are being discussed, and where we're seeing investors have success. We're bringing exposure to the asset class, hedge funds, private equity, private credit. So then ultimately it's about investors being able to get that type of exposure, and to do it with institutional funds that have seats at the cap table of some of the most innovative companies, and that otherwise have significant barriers to entry. So it's really about having that approach for the advisor and the investor to say, okay, these are all important dynamics. How do we take advantage of them, right? I mean, through time, I've had conversations with advisors, and if, let's say the conversation, as an example, went to, we should be taking advantage of arbitrage opportunities or real estate opportunities in Southeast Asia. So my question sometimes jokingly to the advisors, all right, well, what do you want to do? Buy real estate there? Do you want your client to go buy homes and then become a landlord in XYZ domicile? No, you would probably find a manager that gives you quality exposure. And what we need to do is be able to measure all these managers and compare apples to apples. And that's essentially what Crystal has done here, is curated a menu of managers that have historically had great success. So they've got a report card that we can look at. And now we can put them all side by side and determine what gives us the best approach at meeting this client's objectives, who wants a little bit of, they want to have capital preservation so that they can use that capital and that liquidity to meet capital calls in the future of exciting and intriguing opportunities, and be able to navigate and pull multiple levers of what the alternative investment universe has to offer.
Yeah. Absolutely. And Alan, one thing I'm kind of curious as you talk about this, how do you guys go about, are there situations where you need to, maybe talk to a manager that's underperforming, or maybe even drop them from the platform? Are there situations that have occurred like this? And, obviously we don't need to get to specific names, but how do you guys deal with underperformance and reassessing, opportunities as they stand?
That is a question I love that question because I get it all the time too. And it's an important element of what our process is like from a due diligence standpoint. So first and foremost, we're an RIA and we don't get paid by funds, which would really create a conflict of interest if a fund was, as you mentioned, Michael, underperforming, right? Obviously, any platform, whether they're a placement agent, broker dealer, they're going to let investors know that, hey, this fund is underperforming, or this fund, we're going to close it down. But really for us, our incentive is in seeing advisors and their clients' portfolios perform within the strategy, as opposed to specific manager by manager that they may select in their portfolio. Mm-hmm. So if we go back to 2010, when we launched our platform, on the hedge fund side, you may have found close to 50 or 60 funds. But it is an ongoing effort to make sure we are curating the menu. And if funds from a qualitative standpoint, meaning, there has been significant departure at the PM level, or other partners are starting to leave the firm, you see investors starting to redeem and leave the firm. And while that is a qualitative assessment, you can see it also in the quantitative elements. The fund has been underperforming relative to peers. And because we have an internal investment committee that's meeting on a quarterly basis and benchmarking the success of managers on the platform to, peers in the industry that we may not be working with, but we may want to have a relationship with, it's important to have those checks and balances. And we are consistently communicating to our investor community the fact that funds are a buy, a hold, or a sell from a qualitative standpoint. A buy is obvious. We have no issue with capital flowing into that fund. A hold is, let's keep a watchful eye on that firm for a period of time, 3 months, 6 months, a year, until we can ascertain if they're making accretive improvements to what they're doing that really has led to redemptions and has led to underperformance and potentially the solvency of that firm. And then another element is to continue to bring opportunities so that when funds are removed or funds do close, there are sufficient offerings for an advisor to continue to meet those objectives of the client. But look, we're not getting paid by funds. And if a fund is genuinely underperforming from a qualitative standpoint, we're the first ones who are going to pick up the phone. We're going to send communications to our clients and let them know that, hey, fund ABC is really not performing relative to its peers. But if we want to stay invested in this strategy, as well as the asset class, here are a handful of funds that would meet the mandate. And then we help advisors talk through why the change, and then really make it very simple to effect that change.
Yeah, that makes sense. And kind of on that note, because I think it's kind of an important piece to touch on when it comes to, like you mentioned, hey, I want to get exposure to the AI sector. How do you guys typically go about that? So obviously there's the, more endowment approach, I should say, like larger institutions. And there's also the wealth management approach where you're working with an individual, maybe as, a couple $1 million, a qualified investor, if you will. But, generally when somebody wants to make an investment in sports equity, AI, how do you guys kind of generally recommend, or how do the RIAs kind of go about making those allocations? Is it one fund? Is it 3 funds? Is it 10 funds?
I think the beauty of the platform is that it is very dynamic and can specifically meet, many of the elements, all of the elements you're referring to. So an investor starts with their interests, and those are strategies or objectives, maybe their investment themes. And then we would ultimately not just buy one thing, because that dismisses the entire premise of diversification. And ultimately, one of the main benefits of this asset class as a general rule. So it's about having exposure to multiple funds. There's data out there that suggests that to mitigate permanent loss of capital, an investor of private markets has to have at least 9 investments. Now, we're big believers because we've seen institutional allocators have 3-4 times that through time, right? It's also how you generate a cash flowing private investment portfolio by having multiple investments, because we understand that it's a lot like dollar cost averaging. It's a lot like laddering, fixed income portfolios. You've got to make an investment in year one. And we refer to it a little bit like the seasoning, right? If you're going to have a barbecue or you're going to make dinner, you got to season the food prior to it being put on the grill or in the pan or whatever it is. And the same holds true for your PE or private fund investments. Year one investments, year two investments are going to take 2 or 3 years to marinate and exit that investment period, and ultimately for managers to start to realize those investments. So if you make a handful of investments in year one, a handful of investments in year two, then year three, by year 4, 4.5, the data is out there. Those typically start to generate cash flow. And then the year 2 investments in year 5, the year 3 investments in year 6, and so on and so forth. And then the burden for the advisor is on the sourcing part, because in order to generate the liquidity, it's to find managers that have historically been able to do that. And with managers who get to sit at the cap table, and with managers who have had the ability to continue to bring those opportunities to their clients, right? So there's those main elements. I got to find the right funds. I have to have funds that are delivering in many environments and in all economic cycles. And that's the value of being a private markets investor. It is really an all-weather strategy. And it just depends on identifying it within what time frame of an economic cycle we may be in. So, I mean, for example, if you're in an expansionary phase and we're starting to see 0 rates and there's significant growth, that's where VC and growth equity would be most in favor. If you find yourself in a contractionary period, then you start to look at lending opportunities. You start to look at distressed opportunities because of folks who went crazy in the expansionary period, now looking to offload certain assets. So there really has to be, for lack of a better word, an all-weather continuous approach to private markets in order for investors to really see the benefits. And therein lies the key. If you're a smaller but qualified investor, how do you continue to deploy capital? Well, selfishly, I'd say your advisor should be working with Crystal Capital Partners.
There you go. That's great, Alan. I'm curious. We've had a lot of these conversations here about, like, obviously what you guys are doing to deploy different elements of different portfolios, working with your RIA clients. Obviously, communication is a big factor in a lot of conversations. How much, you have a large analyst team of folks internally that kind of have conversations with your clients on an ongoing basis. What does that look like?
Well, the delivery of information is all happening behind a firewall. We think that the user interface or the website is fairly intuitive to use. We do have a team of analysts. We have 3 folks on our investor relations team, which is my team that I lead. And we are the ones who are in touch with our advisors, right? Listen, ultimately, you're talking about advisors who have qualified clients. You're talking about advisors who are entrepreneurial and have that spirit and want to continue to grow their businesses, and are gravitating toward alternatives because of the reasons we said from an investment standpoint: the low vol, the potential for growth, the potential for premium of income. And some of those benefits are also very important for the advisor's business, right? The advisor should be looking at alternatives because it also helps to insulate their revenue from the daily drops of public equities, and the ability for them as advisors to have annuitized businesses, lines of revenue, right? Revenue streams, because ultimately that makes their businesses also more attractive for acquisition. And listen, advisors, none of us are going to work forever. There will come a time where we would like to monetize the businesses that we've created. But we are in constant contact with our advisors. It's happening through the website. You guys mentioned, how do we use artificial intelligence? Those are more of the elements that are coming online, so that an advisor can come onto our platform, again, behind the firewall, go through a specific manager's research, read through their information, read through the holdings within a portfolio, and really have a very transparent view into an asset class that has historically been referred to as pretty untransparent. And that really is simply a fallacy. It's just a matter of the fact that if you're not a registered investor or a subscribed investor, these funds who are registered with the SEC or are registered with the NFA or other regulatory bodies, they're private partnerships and they don't have to publicly disclose their information. So perception, which inevitably becomes reality, is, oh, well, hedge funds and private market funds, they don't provide any transparency. But that's simply not true. And any investor that is invested with their advisor into our platform has access to more information than they'll even know what to do with, to be quite honest.
Alan, before we had this call, you showed us, a couple like pretty cool charts. The one thing that kind of stood out to me the most was the distribution of returns, in terms of seeing how managers perform over time, kind of thinking about that bell curve where, the multiple standard deviations, if you will. Kind of talk to us about the distribution of returns. Kind of how do you guys look at that? How do you guys think about that? And it's there in your logo too, right behind you. So why don't you tell us a little bit about how you think about distribution of returns?
I was just going to say, Mike, we take distribution of returns, normal distribution, very seriously, right? We put it into the logo right over my head. Listen, ultimately, it's about compounding. There are many principles of why invest, but we really think it's about beating inflation, having liquidity, and where do you get the liquidity from your investments? And in order to do that and to compound at an attractive rate of return, you have to have normal distribution. If you were to look at an S&P 500's histogram, like an image behind me, you'd see fat tails or really barbell distribution. So the right and the left side of that histogram would be extremely accentuated. And that's not to say anything's good or bad, but it just suggests randomness. And because none of us have an infinite time frame for investment, it's important to really have investments that through time can deliver what the histogram behind me, the logo behind me does, which is normal distribution, so that through time, you can have moderated volatility, whatever that means to you. But in our world of investing, we want to try to have something like a fixed income vol, and we know we're not getting the equity-like returns, but we're big believers in the rule of 72. And if we have an attractive enough return, we can really double our asset base within anywhere from 6, 7, 8, or 10 years. And again, it's the same consistent approach. I think if there's a theme or a lesson to be had, as in life with anything, to be good at it, it just takes consistency. But many investors don't spend as much time looking across the ecosystem and the landscape like they might use Travelocity to compare 17 flights to get from Miami to LA. And the technology and the tools are out there to be able to do the same things. So, as investors, we want to find more investments that have the personality of that normal bell curve distribution that you see behind you. So that it has, not that the past is predictive of the future, but it does have some element of predictability. I have an expectation of what these investments can do through time. And by the way, they have liquidity, especially on the hedge fund side. So if in fact they are not, changes can be made.
Yeah, that makes sense. Yeah, try to get those consistent returns instead of those kind of far tail returns where it might be, huge to the upside, but also could be detrimental to the downside. Kind of try to stay more.
Like, what if listen, your guys' podcast is highly successful and you get to the point in your life where you're like, you know what, I really don't want to do this anymore. I'd rather do something else. And then you've got a lot of money invested, the bulk of your net worth invested in public equities. And you've benefited from the upside. And you, like all of us today, we're young people, but 35, 40 years from now, we no longer have those 40 years or those 10 years of work should public equities draw 20, 30, or 40%. And you can't say, well, Alan, that's not really a possibility, because only in the last 24 years, we've seen that drawdown happen almost half.
That's right. Absolutely.
Yeah.
So for investors looking, there's another element to the conversation. We'd have it another time, but there is the active income and the passive income. We are trying to help investors with having genuine opportunities to protect their profits and have passive income experiences that give them, again, the ability to compound and to do it with strategies that have return profiles and DNA, like what you see in the logo over my shoulder, versus active income, which is the work that all of us are doing. And the reality is, if you want to make triple digits and consistent 10Xs, it's not by buying, private companies. It's really by doing the work. So at a certain age in your life, when you can do the work and have access to investments that can give you that peace of mind through time, and then obviously when you head out into next phases of life, that's really what the opportune and important part of what alternatives can bring to a portfolio.
Yeah. Well said, Alan. Absolutely.
Awesome. Alan, anything you want to talk about before we wrap up here? Any final thoughts?
You guys have been very kind with your time, and I appreciate the opportunity to provide a platform, or to get on your platform to talk about ours, and really discuss the benefits of alternatives. Because at this point, the investing world, we touched on it a moment ago, a little bit earlier in the podcast, where the time-tested advisor plan for most investors is a 60-40, and that has served investors well. But we've seen it in just the last, if you want to use the last 5 years, but really we're big, math geeks over here. I say that affectionately, and we like to look at lots more data than just, maybe the last 60 data points. But when you look at periods of 120 data points, 240 data points, it is no longer really an argument as to whether or not alternatives should have a place within the portfolio. But it is imperative for advisors, as they expand to a three-legged stool, meaning public equity one leg, public fixed income, and then alternatives, that there is a tremendous product proliferation happening, because alternatives have gained so much popularity. And as a result, it is more important possibly than ever for advisors and their investors to have really a discerning eye, and to find managers that will deliver on the mandate and have done so through time.
Absolutely. Awesome, Alan. Well, this has been a lot of fun. Really appreciate the time. Appreciate you joining us. Where could people go to connect with you and learn more about Crystal Capital?
I would say come to our website. There is loads of information available. All you need to do is go to crystalfunds.com or crystalcapitalpartners.com. Both domains will get you there. Or you can even search Crystal Capital Partners using your favorite AI tool or search engine, and that will get you there. But again, we'd love to chat with you if you're an independent advisor, and discuss how we can help you with your ongoing search for alternatives, or even if you're a fledgling to using alternatives, whether you're the most experienced user or someone who's beginning to incorporate into the practice, we can have a place for you to support you.
That's great. Well, this has been great, Alan. We'll make sure to include all that in the show notes as well, as far as your contact info.